In this video, we're going to be looking at three stocks that have recently had an unusually high number of super investors betting on them. These are investors that are known for being very fundamentals driven. Now, they all have slightly different ideologies when it comes to things like position sizing and diversification, but in general, they're known for doing very extensive research and making a small number of high conviction investments in companies that they see long term potential in. So, I have about 50 different super investors that I track to keep tabs on what companies they're buying and selling, partly because I'm curious, but also to make sure the companies I buy are better than Jim Cramer's list of hot stocks to buy now. What it is a report that shows the total number of different super investor funds that either bought or sold a given stock over the past 90 days, and it's based off of their 13F filings. And what I noticed recently is that there are three stocks in particular that these super investors were buying pretty heavily going into the new year. So without further ado, let's just dive right in. So I'll start with one company that's been brewing up the most attention lately. And no, I'm not just talking about my attempts at making a latte at home. I'm talking about Starbucks. They had the highest number of new super investors buying this stock, more than any other company, with six different investors buying it. Starbucks finished 2024 essentially flat, but overall, it was a pretty volatile year for them. The stock dropped significantly after their Q2 earnings call due to a 4% global decline in same store sales, which included a 7% decline in transactions in North America and a 11% decline in same-store sales in China. And the reasons they cited for this were mainly a more cautious customer that weighed down store traffic. And this was kind of a theme that we saw across multiple different industries throughout the year. Because of higher interest rates and inflation, people were trying to cut back on discretionary spending, which Starbucks fits into. But then in August, almost that entire decline was reversed when it was announced that Brian Niccol, the former CEO of Chipotle and Taco Bell, has been appointed as their new CEO. Chipotle has been one of the best performing fast food stocks of the decade, and since Brian Niccol took over Chipotle in 2018, the stock went up nearly 10x. So, needless to say, investors have high hopes for him. And to be fair, he does have a well established track record of making meaningful changes to fast food chains. And something he really likes to do is simplify menus and try and get better at the very thing that the restaurant initially became well known for, whether that was fresh ingredients in the case of Chipotle or the famous lack thereof in the case of Taco Bell, which was a criticism of Starbucks that their menus had just gotten too long and too complex, and customers were waiting too long to receive their orders. So Brian Niccol wants to change that. He wants to ensure orders don't take longer than 4 minutes to get served, and simplifying the menu can help achieve that. And also, he wants to encourage people to linger around in stores more. So they're going to add more seating, and they're also going to get rid of the non dairy milk upcharge, which was something that customers found annoying. So the fact that six different hedge funds have recently purchased Starbucks stock not only tells me that they have faith in this turnaround plan that Brian Niccol is going to be responsible for implementing, but also they still see the overall value in the Starbucks brand. And Starbucks is objectively a very high quality business. Return on invested capital is more than double the industry median, and profit margins across the board are significantly higher than the industry. And their store count is still growing both in North America and internationally. And then from a valuation perspective, the company isn't particularly cheap right now, but it's also not overly expensive either, trading at a PE ratio that is about where its historical average has been. So ultimately, what you have with Starbucks is a high quality business that's being led by someone with a strong track record and isn't valued too expensively, which would be attractive to a lot of these super investors. The next company that super investors are buying is definitely one of the more controversial companies that exist today, and that is Live Nation Entertainment, which is the parent company of Ticketmaster. Anyone who's ever tried to buy or sell live event tickets on this platform has seen the obscenely high fees they charge and probably knows what I'm talking about. Live Nation and Ticketmaster merged in 2009 to form the company we know today. Live Nation before was a event promoter, so they own the rights to a bunch of concert venues around the globe, and Ticketmaster is the online ticketing platform, which became the dominant player in this market primarily because they entered the market very early. They first launched their website in 1996 when the internet was just starting to become mainstream, and they locked in exclusive contracts with major venues, which eventually made them the default ticketing service. So Live Nation today is a $30 billion company that is still growing pretty fast, double-digit revenue growth over the past year. Their operating margins aren't massive, they're in the mid-single digits right now, but their return on invested capital is more than double the average for their industry, over 20%, which does signal a competitive advantage. And the company did very well in 2024, going up by about 40% that year. Now, the company's recently come under some antitrust scrutiny where they were accused of being a monopoly in the live events sector. And what they're trying to do is break up Live Nation and Ticketmaster into two separate companies. So basically reversing that merger that took place back in 2009. And Live Nation's lawyers responded to this with a blog post essentially arguing that this business is very competitive. Their net income is only 2% of concert revenues. They even pointed out other network-based companies like Twitch and Uber, saying that these companies take a much larger share of customer money, which isn't really a relevant argument from an antitrust perspective because what they care about are things like exclusive contracts that block competition or product tying where you force customers to use services they otherwise would not purchase from you. Most companies try and convince their investors that they have some sort of unique competitive advantage, something that the competition can't match. Very few companies have to hire lawyers to convince regulators that their businesses are actually more competitive than people think they are. Usually, those are the companies that actually do have a real competitive advantage, which probably explains why this company is now starting to receive some love from the smart money because they love companies with economic moats and durable competitive advantages, and this antitrust case, if anything, is just evidence that this company has that. Live Nation owns pretty much every aspect of the concert experience: the fees on ticketing, the revenue for the venue, the parking at the venue, food, drinks, merchandise. They even earn sponsorship revenue from corporate sponsors at their events. And the sector they're in has been performing very well. In their Q3 earnings call, they said 20 million tickets have already been sold for 2025. So demand for live events is very strong right now. And the industry is one that has come back extremely strong since 2020 when it was effectively shut down. The total market size grew 53% 2020 to 2023. And the live music industry is expected to grow pretty fast, around 16% annually for the next 5 years. Now, the final company that super investors have been buying lately is Sherwin-Williams, which is an $85 billion paint company. Now, this one is also interesting because I have two reasons as to why this company is on this list. One of them is my more logical reason, and the other one is my more conspiracy theory reason. And just for fun, we'll start with the conspiracy theory. So there is this growing idea in the world of investing that with the proliferation of passive investment vehicles like ETFs and index funds, it has led to a significant portion of market activity being driven by capital flows into and out of these indices rather than being based on individual stock fundamentals, which basically means that the fundamental structure of markets has changed over the past few decades. When money flows into a passive ETF or index fund, the underlying securities of that fund are bought indiscriminately, so completely irrespective of any fundamental indicators for that particular stock. And Sherwin-Williams was just recently added to the Dow Jones Industrial Average. It was added on November 2024 along with Nvidia, and the company it replaced was Dow Chemical. And since there's many large ETFs that passively track this index, Sherwin-Williams is now going to be receiving those capital flows, which will increase the demand for this stock, driving up its price. For example, there's the DIA ETF, which is managed by State Street and holds approximately $38 billion in assets under management. There's also a few other smaller funds that track this index as well, like the iShares one. This one has about $3 billion in AUM. Now, the total number of investment dollars that are tracking the Dow Jones index versus, say, the S&P 500 index is significantly less, and Sherwin-Williams was already included in the S&P 500. However, if this trend of passive investing continues, which it likely will, and more dollars start tracking this index, Sherwin-Williams will keep receiving those capital flows in addition to the flows they were already receiving from their inclusion in the S&P 500. But with that being said, there's also some fundamental reasons as to why investors are starting to buy this company right now. For starters, now that the Federal Reserve is starting to cut rates, this should lower the 30-year mortgage rate and increase housing market activity, which would boost sales for Sherwin-Williams because usually people buy paint when they're in the process of buying or selling a house. And this is something that has actually weighed down the sector for a while since housing market activity has been low for a while now due to the relatively high mortgage rates. Also, a key competitor to Sherwin called Kelly Moore ended up going out of business back in January 2024 due to multiple lawsuits that they were facing. Now, this was a much smaller private company. They had about $400 million in revenue versus Sherwin that had $23 billion in revenue last year. And they were particularly prominent in areas across the West Coast, and they had over 150 retail locations in that area. So, what is expected to happen is Sherwin will gain market share in the region this company used to service, which will help increase their revenue going forward. So, I think that combined with how some investors might want to get ahead of certain sectors that are going to benefit from the upcoming rate cutting cycle, even if that rate cutting cycle doesn't happen as fast as people initially thought, I think those are the two main reasons as to why people are starting to get interested in Sherwin-Williams specifically. But if any of you guys have more additional insight into these companies that you want to share in the comments, please feel free to do so. So that does it for this video, guys. I hope you did enjoy it and you found it useful. If you are interested in seeing the report that I use to see this data on what stocks super investors are buying and selling, you can view that data on my website. It's called Tickernomics.com. It's free to use. Just go to public scripts once you log in and type in stocks net bought by super investors. That's the name of the script that creates this report. And when it comes up, just click the run button and it will run for a couple seconds and then give you the most recent list. But thanks anyway for watching, and I will see you guys in the next video.